welcome back to the show. My name is Mike, this is my whiteboard, and today we're going to be covering the difference between IV rank and IV percentile. So we actually just released a new IV rank or IV percentile adjustment in the Doe platform just last night. So if we go to the next slide, I can show you exactly where that is. On the trade page, if you pull up the trade page, the curve view, you type in any underlying there, you're going to get the IV rank circle as you see here. So I pulled this yesterday, IV rank was around 47. And now what you can do is click on that IV rank circle and you can actually change your IV rank type. So you can change it from a 52-week TOS style IV rank, which is the exact same number you're going to see in the TOS platform, or you can select any of these IV percentiles. So some of you might be saying, well, we use IV rank, what is IV percentile? And that's exactly what we're going to break down today. So we've got a 30-day, a 60-day, a 6-month, and a 1-year IV percentile selection now. And it's just a different way to look at the calculations. It's another way to visualize and really interpret where the implied volatility is in relation to itself over these certain time frames. So let's go on to the next slide and we'll first talk about IV rank and we'll look at the calculation for this. So IV rank is what we've been using on a lot of the segments. We talk about selling premium in high IV environments, and usually we look at IV rank over 50 or anywhere around 50 is usually good enough for us to be selling premium. And really what we're doing is taking the current IV, measuring it against the 52-week low and the 52-week high. So the actual calculation is taking the current IV, subtracting the 52-week low, and then dividing that value by the 52-week high subtracted from the 52-week low here. So if we have a current IV of 100%, and over a 52-week time frame, we had a low IV rank of 30%, but a high IV rank of 150%, then this is what the calculation would look like. We'd have 100 minus 30, which would give us 70, divided by 150 over 30, which would be 120, and that gives us this percentage of 58.3%. So an interesting thing is that IV is not capped at 100. Although IV rank is, because really we're just ranking the current IV on a scale from 0, which is the 52-week low, to 100, which is the 52-week high, implied volatility itself can be anywhere above 100%. I just looked at the VIX earlier today, and I think the current VIX expiration that's expiring today is over 200%, which is insane. But as you can see here, the raw implied volatility can be over 100%. So that's why we're looking at IV rank. So the reason we look at IV rank is because we're looking at different underlyings that have different implied volatilities. We're going to get to another slide here in just a second where we're going to look at a few different graphs of implied volatility and we're going to see the reasoning behind IV rank. But the first big takeaway here is that IV rank only looks at the IV high over a 52-week period and the IV low over a 52-week period. Once we figure out those 2 points, we can measure where we are currently, and that's what it's going to give us that percentage down here. So the first thing to take away from IV rank is that it's a very simple calculation. If I can easily see the IV rank low and see the IV rank high over a 52-week period, I'm sorry, I should be saying the IV high and a IV low over a 52-week period, I can take the current implied volatility, measure it within that range, and give myself a percentage here, or just eyeball exactly where that is. So there's a difference when we look at IV percentile compared to IV rank, and that's the fact that it's going to be a little bit more complex. So let's go to the next slide here, and we'll talk about the calculation for IV percentile. So the big difference between IV rank and IV percentile is that IV percentile does not just look at the IV high and the IV low. It's going to look at every single data point and every single day that the actual underlying is trading. So the IV percentile calculation is going to be the number of days under the current IV over the number of trading days total. So in that same exact scenario, let's say that if I had a current IV of 100% and I knew that my IV high was 150% and my IV low was 30%, if I've got a current IV of 100% and 200 out of the total 252 trading days, the IV was lower than 100%, it would give me an IV percentile of 79.4%. So as you can see, the two numbers are a little bit different, and the reasoning is because of the fact that IV rank is going to look at just the high and the low, where IV percentile takes all the data points into considerations, and it gives you a much smoother calculation. So let's go to the next slide, and we'll look at some visuals here in terms of IV rank. So I've got three different scenarios here. The very top one is looking at an IV over a 52-week period between 20 and 30%. So you could say that this is an underlying that's really not too volatile. Sure, 20 or 30%, an underlying moving that much in a certain time frame, 52 weeks, can still be pretty volatile, but the fact that it's staying between 20 and 30% for an entire year means to me that it's not too volatile. It's a pretty mediocre in terms of volatility underlying. So basically what we did here to find the IV rank is we looked at the low point, which would be right down here of 20%, and we're measuring that against the high point, which is 30%. So when we're looking at IV rank, it's going to be taking that 20% low, assigning that a 0 value, and going to the 30% high and assigning that a 100 value. So now we would look at the current implied volatility, measure that against the low of 0 and the high of 100, and that's where we get our rank. So in this example, a 50 IV rank would be right in between there. It would be 25% raw implied volatility. And I know that is the case because if 0 is assigned the low of 20%, and 100 is assigned to the high of 30%, if I go right smack dab in the middle at 25%, that's what's going to give me that 50 IV rank. It's right in between 0 and 100, so that's what gives me the 50 there. Now we're looking at a different situation where we're much more volatile. So this was the example I was referring to in the first IV rank calculation. So now we're looking at an IV low of 30%, which you can see is right here, and we're measuring that against an IV high of 150%, which is right up here. So the difference between IV rank and IV percentile, again, is that IV rank is only going to look at this low point and measure it against that high point, and anywhere in between here is going to fall in between and give you an IV rank. Where IV percentile is going to take each one of these days, let's say these are weekly spikes, so here's 1 week, here's another week, here's another week. Basically what it's going to do is take all those data points into consideration. So this spike in IV and this low in IV is going to be smoothed out. It's not going to have such a drastic change on the IV rank as you saw with the IV rank calculation. So when we're looking at IV percentile, it's much more smooth of a calculation, although it is more complex because we have all these data points we have to consider. It's going to give us a more smooth calculation. Some people like it over IV rank, but I think the important thing is whatever you're more comfortable with using, just stick to that. Be consistent, because if you're switching between both of these, it's going to be confusing and kind of get you off track of where you were looking previously. So if I'm looking at IV rank for 6 months and all of a sudden I jump over to IV percentile, it's going to be giving me a different number, and maybe a spike or a drop in IV percentile isn't going to have that same effect that it would have if I was still looking at IV rank, since it was something I was familiar with. So lastly, we've got a very low IV underlying, and I think this is potentially one of the issues with IV rank, is that when we're looking at just IV rank, if we don't look at the actual implied volatility, we can get ourselves into a situation where we might be selling premium when there's really not too much premium to be sold, or buying premium when we think it's low when it's really not. So this is a super low implied volatility underlying. As you can see, over a 52-week period, the raw implied volatility was only ranging from 7% to 10%. Now, you can see there's only a 3 percentage point difference as opposed to this one where there's a 120 percentage point difference here. But with this one, with IV rank, we still have to assign it a low and we still have to assign it a high. So the 7% low would be somewhere around here, and that 10% high would be somewhere around here. Now, what's the importance of this? Well, if we're talking about actual pricing models, a slight change in implied volatility like this, 3 percentage points, isn't really going to change the pricing of the options too much. Although a 7% IV is going to give me a 0 IV rank, and a 10% is going to give me a 100 IV rank. So over the course of a few days, I might go from 0 IV rank to 100 IV rank, and I might think there's an extreme opportunity there. But if I actually look at the raw implied volatility, I might see that it's only jumped from 7% to 10%, which really shouldn't change that option's pricing too much. So it's really important to, number one, look at the IV rank or IV percentile, whichever calculation we're using first. But then we want to still dig into the raw implied volatility, because the raw implied volatility is really what's going to be the reflection of the option prices. Again, implied volatility is just a reflection of the option prices. If option prices are increasing, the input for the Black-Scholes model, which is the implied volatility, we can't really know that number and input it into the Black-Scholes model. We can take all the other inputs and figure out or get close to figuring out what implied volatility is. But since we don't actually know the implied volatility value, we know that the option prices are dictating implied volatility. So whether we're using IV rank or IV percentile, the important thing to remember is to always look back at the raw implied volatility, because if I've got a situation like this, it might be much less lucrative than a situation here where maybe I'm selling premium up here and watching it drop all the way down there, which would probably give me a much bigger profit than if I were to be selling premium up here and have it only drop down to 7% in this example. So that was a ton of information, but let's wrap it up with some takeaways on the last slide here. So the first takeaway is that IV rank is a simple calculation. I can easily see the 52-week low, measure it against the 52-week high of implied volatility, and see where my current implied volatility level is. I can easily just map it out and give myself a visual of where that IV rank is. IV percentile, however, is a little bit more complex. There's a lot more data points going into it because we're looking at each and every single day, regardless of the IV high and the IV low. While yes, it will have an impact on the IV percentile, it's not going to have a drastic impact like you saw it have in the IV rank calculation. If we get a spike in implied volatility, it's going to alter that high for the IV rank, whereas in IV percentile, it's just going to skew it a tiny bit. It's not going to totally drastically change that calculation. So with that said, IV percentile is going to be smoother. We're not going to see those big spikes or big drops in implied volatility having a great effect on IV percentile as you might see it have an effect on IV rank. But really the question is going to be, which one should I use? Which one's better? In all honesty, it's going to be up to you. You can use IV rank if you're more comfortable with it. IV percentile, if you have the ability to figure that out calculation and be able to calculate that consistently, then by all means you can certainly use it. We've got it all in dough, so you can check out the 52-week IV rank, or you can switch off between the different time frames for IV percentile. But really just be consistent. If you're consistent with an underlying in the calculation, you're going to give yourself the best probability of success in the long run. So this is the difference between IV rank and IV percentile. Thanks so much for tuning in. Hopefully you enjoyed it. If you've got any questions or feedback, shoot it over to these emails or shoot me Trader Mike. We've got Jim Schultz with Theory to Practice coming up next though, so stay tuned. Hey everyone, thanks for watching our video.
If you liked this video, give it a thumbs up or share it with a friend.
Click below to watch more videos, subscribe to our channel, or go to our website.